session, we're going to talk about indicators. The first indicator we're going to review together is the moving average indicator is a widely used technical analysis tool. In essence, moving average refers to a calculation that updates the average price over a specific period. It effectively turns the market's volatile fluctuations into a smoothly flowing line that follows the price action to help traders see the trend. The moving average indicator is considered a trend-following indicator. This indicator cannot be used to predict the future, but it can be useful for describing the current situation. The moving average is calculated from previous price data. Now everyone, I want to decode this note for you. There are a lot of hidden and key points in it that we want to go through together one by one. It says, what is a moving average? It's an average that turns the market's fluctuations into a moving line. Let's go. Let's watch just this first part together. Now, what exactly does that mean? We previously talked about candlesticks and said that, for example, right here in this specific section, we can actually have several different candlesticks appearing at once. Right? Now, for example, among these, let's say I also add a few red candlesticks. So, for instance, if we take a closer look at the data, we're currently observing a specific part of a broader market trend right here in this section. Now, after this, we want to see how the moving average that we put on your chart works. How does it appear as a line on your chart? Guys, we said that this moving average moves along with the candles as a single line on the market, right? So how does this actually happen? It's not inherently a line by itself. That is, from the moment we select a value for the moving average. For example, we say a moving average with a period of 10. What does that mean? It means it takes the last 10 candles. Now, let's go through an example. On 5, 1, 2, 3, 4, 5, it selects these 5 candles together. For example, it takes the average of the past 5, adds them up, and divides them by 5. Whatever the average turns out to be, for example, it becomes a point here. When it gets to the 6th candle, it takes this candle along with the previous 5 from number 2 to number 6, adds them up again, calculates, takes the average, and places another point. Here, when it gets to the 7th candle, it takes the average of numbers 3, 4, 5, 6, and 7 together. It places a point here again, and when it gets to number 8, it does the same thing again. 1, 2, 3, 4, 5, from numbers 4, 5, 6, 7, and 8, it does the same. It places a point here, and then it very intelligently selects these points. What does it do with them? It connects them together, and we see it as a line. This line keeps calculating the average and continues onward. Now, which of the 4 options that this candlestick provides does it average? That is, does it average the high, low, open, or close? Which one does it sum up and calculate on these candlesticks so that it can place its point here? We can adjust this in the settings of the moving average. For example, we can tell it to take the average of the highs, or set it so that the average is applied to the close, just like it is by default in most traders. When we go into the settings of this moving average, I'll show you there in detail that we can specify this. Take the average of the close, take the average of the open, take the average of the low, or take the average of the high. Well, this is one of the simplest types of moving averages, called the simple moving average, or just the simple moving. As we know, there are many different types of moving averages available to us. And by now, we have thoroughly understood exactly how the simple moving average works and how we can effectively use it in our analysis. So let's continue decoding and discussing this further. Now we've learned how it turns into a moving line. Now it moves along with the price. All right, you've understood this as well. Because when a new candlestick is formed, it again adds up with the previous ones, takes the average, and creates another point, which the line then connects to. The moving average indicator is a trend-following indicator. Okay, so it means it moves according to the trend that the candlesticks determine. This indicator cannot be used to predict the future. Why is that, guys? Even when we look back here, we see that a new candlestick needs to be formed here. The characteristics of this candlestick are only known after it is completed and closed. Only then is it made available for the moving average calculations to create the new point. So it can't move ahead of our chart, but it can be useful for describing the current situation. Okay, the moving average itself acts as a kind of support. When prices are above it for several periods, or when the candlesticks fall below it, it can be considered a resistance. All right? Its usefulness is in the present moment. The moving average is calculated from previous prices, which we've discussed in detail. Now let's move on to the types of moving averages. We have different types of moving averages, and here we'll get more familiar with two of them. One is the simple moving average SMA, and the other is the exponential moving average EMA. These are the two moving averages. The most popular moving averages used by traders are from the moving average indicator. They are used to determine market trends and support and resistance levels. Now, some people ask, well, what does exponential mean? We understood simple, but exponential works like this. Let's take a closer look at this together. We previously mentioned that whenever we use the simple moving average, it specifically takes into account the final closing prices of the individual candles. For example, if we set it to 5, it averages the last 5 values. For instance, it adds 1 plus 2 plus 3 plus 4 plus 5, then divides by 5. That's how it's done. The resulting value is based on the closing prices, and that's why it's called simple. So what's the difference with the exponential one? How does the exponential moving average work? In the exponential type, we say that more weight should be given to the most recent candles in the calculation. This means that as you get closer to the end in the calculation, you put more weight on the most recent candles and calculate it for us. What does that mean? It's like the university entrance exam, kids, where each subject has a coefficient, right? For example, they say general subjects have a coefficient of 2 and specialized subjects have a coefficient of 4. What does that mean? It means their average has a much greater impact on your report card or your overall score, right? Here too, in the exponential moving average or EMA, the last candles have a higher coefficient. Let's continue. Let's review the previous example. So if the candle that was our number 1 was multiplied by 1 plus the candle, it multiplies our number 2 candle by 2, adds it, then multiplies our number 3 candle, for example, by 3, and adds it, multiplies our number 4 candle by 4, and multiplies our number 5 candle by 5, and then we take the average of all these, and that's how we arrive at this point, right? So as you can see, it's like we've brought in the general courses, we've chosen the earlier candles, we have coefficients 1, 2, and 3. For our specialized courses, we've chosen the last candles. 4 and 5, which have coefficients of 4 and 5. They have the highest coefficients, but at this first level, their coefficients are much lower. So this shows that the average that is output here gives more weight to the last candles, or is more influenced by the last candles. And what is the truly beneficial advantage that this brings to our daily work? It is that when the very last candle has a significantly greater level of influence, in a certain way, our moving average aligns itself much more closely to our chart and can consequently give us much better trading signals. So these are the two types of moving averages. Now the simple moving average, which is the simplest type of moving average in Forex analysis, is just a simple moving average. By adding the latest price of the X time period, which in our example here, what did we say? For instance, we said the past 5 periods, and then dividing that by X, meaning dividing it by 5, just like the example we just gave, it calculates the moving average. This gives you the moving average. Again, as we mentioned in the definition, if you use this method, it calculates the moving average for us. The amount of lag that exists in the simple moving average indicator will be reduced. Why? Because in this method, the most recent candlesticks, as I mentioned before, have more weight. In the market, these new candlesticks are the same as the recent candles. The last 5 that I mentioned, which we see at the end, have more weight in the calculated average. It's as if those specialized courses have a higher coefficient. This is also a definition. With these two, we can also have a way of generating signals or trading using moving averages. How does it work, the moving averages? When we use both of them at the same time and set different periods for each, we set one with a longer period, for example 30, and the other with a shorter period, for example 15. So when we set two moving averages, and each of these moving averages does its own calculation with a different period. So it's definitely the case that the moving average with the shorter period, when a reversal is about to form in the market, reacts faster compared to the moving average with the longer period. To put it simply, it's like one moving average is a mischievous boy. Very energetic. We consider him someone who can go up and down very quickly and change his position fast, but the moving average with a higher period is like a middle-aged man who moves cautiously, takes calculated steps, and doesn't have that excitement of jumping up and down. Now, in the differences these two have with each other, that is, wherever they cross each other or one cuts the other, the moving average with the lower period comes and cuts through. It creates a crossover, and we call the moving average with the higher period that. Crossover or intersection or break, at those points we can use these moving averages as a signal. When the moving average with the higher period is continuing its movement here, and the moving average with the lower period comes and breaks through it, whether it crosses upward or downward, it gives a signal. The direction in which the lower period moving average is heading indicates the trend direction for us. Take a look. In this method, we need at least two moving averages, guys. At least two, pay attention. We can use more than two moving averages, but with fewer than two, we can't observe any crossovers. A single moving average by itself doesn't have any crossovers. So at minimum, we need two to be able to see the crossover. But there are strategies where 3 or even 4 moving averages are used. One with a longer period, which is slower, like the middle-aged one, and another with a shorter period. That means the faster one, as we said, is more energetic, younger. When the faster moving average crosses over the slower moving average, a sell signal is generated in the market. And whenever the faster moving average crosses above the slower moving average, a buy signal is generated. Using this method does not work well in ranging markets. Guys, this is the main pitfall of moving averages. They're all about ranges. In a market that's ranging, calm, without a trend, where prices aren't moving up or down, moving averages tend to give a lot of false signals. Of course, in the strategy section, we'll teach you exactly what we mentioned earlier. Candlestick analysis, hammer, doji, and shooting star patterns on their own are just confirmations. In the strategy section, we'll teach you that if we're using moving averages in our strategy, the moving average is only one confirmation and we need other confirmations as well. For example, the market shouldn't be ranging because in such cases, the moving averages are constantly intertwined and tangled together. But in trending markets, they work excellently. And recently, a small range breaks this, and it also breaks upwards, breaks the base, and it doesn't work. You need to get good signals, but in a trending market like the one I've shown you with XAUUSD now. See how useful it can be? Just with a confirmation. Well, as we said, when a crossover happens here, this crossover causes an uptrend here. It creates this for us, guys, in the confirmations I mentioned in the candlestick section. Do you remember? When we have a hammer, that is, at the end of a downtrend, seeing a hammer is a confirmation. For profit, look here exactly. We have a downtrend, and here we have a hammer. I'll draw this hammer here. A bit bigger, this became our first confirmation. The moving average crossover here became our second confirmation. So now with two, the confirmation is a bit stronger, we have more confirmation, and we can easily secure profits from the uptrend in the market. All right, let's move on to the next topic, Bollinger Bands. But before that, let me talk to you a bit about Bollinger Bands. When we used to draw channels, we would say that the price should move within this range. That is, when we had a trend line and it would go up to a certain range and then come back down. The lower part of the channel that was formed looked like this. Look, for example, we would say here we have a trend line, right? When we have this trend line, we determine it with these two valleys and one peak, drawing the trend line and the channel. We say that it should move within this range, but there's a problem with the channel. Is that it makes things too rigid for us, meaning it tries to fit everything inside two very strict, inflexible lines. You might say the market has to move here, but in reality, the market often doesn't do that. That's why sometimes it hits inside the channel, sometimes it goes higher, and sometimes it drops lower. But Bollinger Bands do the job of a channel, only much better. What does that mean? It means it's more flexible, it adapts to price movements. We really like it when a price on the chart moves in a way that you can consider an average for it. So it tells us that the price can drop to this range and can go up to that range, except for those times when some news or fundamental events come out and suddenly cause a spike. Overall, it creates volatility in the market, but under normal conditions, just like we expect movement within a channel. The price moves within the Bollinger Bands with greater flexibility. This is what we expect from it. Now let's talk about its definition. Bollinger Bands is a chart indicator created by John Bollinger to measure market volatility. In fact, this small tool helps us distinguish between a volatile market and a calm market when the bands get closer to each other. It indicates that the market is calm, and when the market is highly volatile, the bands move away from each other. Let me give you an example. When price fluctuations become small, well, our Bollinger Bands consist of three parts: the lower band, the upper band, and the middle line. These upper and lower bands act like a channel for us. What happens when they get closer together? We know that generally market volatility is lower. When the market is ranging, these bands get very close to each other. But when the market starts moving, then the upper and lower bands begin to move significantly apart, shifting either upwards or downwards. And basically, this range effectively forms the logical movement of the market between them. And the price action tends to almost always move within the boundaries of the Bollinger Bands. What happens when the price hits the Bollinger Bands? These bands act like support and resistance, keeping the price inside the Bollinger Bands. When a candlestick closes outside the band, the probability of a market bounce is also stronger. Well, the idea is like this. Imagine these two bands we have. One is the lower band and one is the upper band. Let's say we have an upward trend, and every time it comes down and hits the band, at the lower band, we expect it to bounce back up to where? Up to the edge of the upper band. And whenever it hits the upper band, we expect it to drop down. So how far is important? Up to the edge of the lower band, right? That's what we expect from it. Now let's give an example as well. Of course, it's possible that it doesn't always move within this band for its entire life, right? When we have a candle close outside the edge of the lower band or the upper band, from that point on, we expect the trend to form in that direction. Let's take a look together and get more familiar with the definition of Bollinger Bands here. As I mentioned, Bollinger Bands are made up of three parts: a simple moving average, the upper band, and the lower band, guys. In the previous session, we talked about moving averages. We said that in the middle of the Bollinger Bands, there's a center line. That center line is a simple moving average, meaning an SMA, simple moving average. The center line of my Bollinger Bands is formed by a simple moving average. What are the upper and lower bands like? The bands that are below our moving average, meaning they are 2 degrees of freedom away from this moving average. For example, 2 degrees lower and 2 degrees higher than the moving average's freedom become the Bollinger Bands. Let's look at this center line together. The simple moving average is usually set to a 20-day period, which is the default setting for the Bollinger Bands when we add it in MetaTrader. The moving average is an average of the stock's price over a period of time, which is usually set to 20 days. What is meant by the average being moving is that the price is not the same over different time periods. Rather, it changes, which we discussed in detail in the moving averages section. Now, what about the upper and lower bands? By using 2 standard deviations estimated to be above the simple moving average, we create our upper band. Well, naturally, 2 standard deviations estimated downward also create our lower band. Let's see. Here's a point, a very important point. When the trend tends to rise, the moving average line is considered as support. And when the trend tends to fall, the moving average line is considered as resistance. What does that mean? That moving average line is the same as the middle line of the Bollinger Bands. It says when the price wants to go up, that is when it wants to break through the upper Bollinger Band and move higher, the moving average line, which is the middle of the Bollinger Bands, acts as support for the price. And when the price wants to go down, when it wants to break through the lower Bollinger Band, that moving average inside the middle line, in the Bollinger Bands, it acts as resistance for it. This indicator should never be used alone. Rather, it must be used alongside other technical analysis tools. Look, guys, I'm emphasizing this for the 3rd time. I'm stressing this because I've seen some people start trading just based on a single confirmation. A confirmation from one indicator or a candlestick pattern. Guys, we should never trade based on just one confirmation. Just like in this example that I showed you. I said we don't use the Bollinger Bands alone or use moving average crossovers alone. We need to have several strong confirmations for our strategy and only enter a trade based on those confirmations.